All right, let's talk about Japan's stock market. I mean, it's hitting highs we haven't seen in more than 30 years. So naturally, everyone's asking the same thing. What on earth is going on? Well, in this explainer, we're going to cut right through all the noise. We'll break down exactly what's driving this incredible surge, and more importantly, what it could mean for you.
You've seen the headlines, right? The Nikkei is just soaring. Some analysts in Japan are even calling it an Ijigen no Saikyo Zoba, basically an unprecedented, super strong market. It's the kind of thing that makes everyone sit up and pay attention. So the billion-dollar question is this. Is this just a massive bubble that's about to pop, or is this the real deal? Let's dig in.
Okay, so here's our game plan for today. We're going to look at what's really driving stocks higher. Then we'll check out which stocks are winning and, just as importantly, which ones are losing. And finally, we'll wrap it all up with a solid investment strategy for the coming week. Sound good? Let's get started. All right, so why is this market so incredibly strong right now? What's fueling this rocket ship? Well, experts have really zeroed in on this powerful combination, a trifecta of key factors. It's not just one thing, but three huge forces all coming together at once. First up, and this one's a biggie, the persistently weak yen. I mean, for Japan's huge exporters, this is just a massive tailwind. Think about it. Every dollar they earn overseas suddenly turns into a whole lot more yen when they bring it back home. That goes straight to their bottom line, boosting profits, and you guessed it, their stock prices. And here's what's really interesting. Analysts are saying this isn't just some temporary blip. They see it as a structural trend. Things like ongoing trade deficits and even capital flowing out of Japan, partly thanks to that new NISA program encouraging people to invest abroad. So the expert consensus? This weakening trend for the yen, it's probably not over yet. Okay, reason number two is the absolutely powerhouse U.S. economy. Seriously, it's not just chugging along, it is booming. And that incredible strength, well, it's like a rising tide that lifts all boats. And Japan's export-heavy economy is definitely one of those boats getting a huge lift. And you don't have to take my word for it. The numbers tell the whole story. Just look at this growth data. You've got Europe and even Japan struggling or shrinking, and then, boom, the U.S. posts a massive plus 4.3%. That's a powerful economic engine, and it's creating demand and confidence that's rippling all the way across the globe. And that brings us to our third and final major driver, the tech revolution. We're talking about the global explosion in AI and, of course, the incredibly advanced semiconductors that make it all possible. This boom is directly fueling some of Japan's biggest corporate winners right now.
One analyst put it perfectly. They said the main theme of today's market is the AI market. AI and finance are the two wheels driving everything forward. And you can see it in action, right? When a global giant like TSMC posts incredible earnings, it sends this positive shockwave through the entire Japanese semiconductor supply chain. It just lifts up all the Japanese companies that are part of that ecosystem.
So, with all these big trends in play, who's actually winning? Which companies are really cashing in? Let's zoom in and look at a prime example of a winning stock that really tells the whole story. A perfect case study is a company like Kioxia Holdings. So what do? They make these essential memory chips that go into AI data centers. And as the demand for AI just explodes, well, so does the demand for their product. The result has been absolutely incredible. The stock has become what investors call a 10-bagger. And yeah, that's exactly what it sounds like. It's grown to 10 times its original value. Amazing.
But, and this is a really important but, this rally isn't lifting every boat. Not at all. It's actually super important to look at the companies that are getting left behind because they give us a pretty clear warning about some potential cracks that might be forming under the surface. Let's take a look at drugstore chains like Matsukiyo. Now, on the surface, it might seem okay. The average person who walked in spent a little more money. But here's the kicker. The total number of customers walking through the door dropped by over 5%. That is a huge red flag. It kind of whispers that maybe the average Japanese consumer is feeling the pinch and that competition is just getting brutal.
And it's not just the drugstores. We're seeing other weird signals too. I mean, look at Sanrio. Yeah, the Hello Kitty company. They're forecasting record profits, but their stock just hit a yearly low. How does that happen? Then you've got shipping companies whose shares fell off a cliff just because one major player announced it was going back to the Suez Canal, which could push shipping rates down. So these aren't signs of a full-blown crisis, but it tells you something really important. Investors are getting way more picky. They are punishing even the slightest hint of bad news. Okay, so let's put it all together. We've got this really powerful rally on one hand, but on the other, some pretty clear warning signs. It's a mixed picture, for sure. So what's the smartest way to play this? What's the strategy for next week? Well, analysts are all pointing to one key metric that's flashing a pretty big signal. The market might be getting a little overheated.
And that brings us to this number, 20. For the first time since the corona shock back in 2020, the Nikkei's price-to-earnings ratio, the PER, has gone above 20. Now, the easiest way to think of the PER is like a price tag for the whole market. The higher it is, the more expensive stocks are compared to how much money they're actually making. And historically, that 20 level is a big caution sign. It doesn't mean a crash is right around the corner, but it does suggest that the days of easy gains might be behind us.
So how do you actually navigate a market like this? Well, the expert consensus really boils down to a clear four-step strategy. First, and most importantly, beware of the overheating. Don't go chasing stocks that have already skyrocketed. Step 2, dips are now your friend. The big strategy is to use any pullbacks on the market as an opportunity to get into those strong, fundamentally sound companies at a better price. Third, if you're a more active trader, keep a close eye on those key technical levels for the Nikkei. Think around 53,700 and 53,200 for potential bounces. And finally, number 4, risk management is everything right now. With major inflation data and a Bank of Japan meeting on the calendar, this is absolutely not the time to be reckless.
So there you have it, a market on an incredible run, fueled by the weak yen, a strong U.S. economy, and the AI boom. But at the same time, it's showing clear signs of getting expensive. The main takeaway is this: the game is changing. It's shifting from just blindly buying anything to being much, much smarter about your selections. In a market this unprecedented, opportunity and risk are walking side by side. The real question is, are you ready to capitalize on it? Thanks for joining this explainer.